not just about buying all the great businesses. We want to buy great businesses at reasonable valuations in the context of IPLs. Obviously, I can't buy 11 Virat Kohlis in the auction. How do you build such a team, and how do you connect that with your multi-factor investing model?
It's basically data that you're looking at. When you're looking at the player stats, remember, you're not looking at just the stats of Virat Kohli or the playing 11 today in the Indian cricket team, right? You're looking at stats for all the players who have played Ranji. I can apply the same process of selecting the team on 100 players. I can do it on 1,000 players. I can scale this up to 10,000 players, right? And you might get the next Virat Kohli. You want to buy the next multi-bagger today, right? In similar way, you want to have the next Virat Kohli in your team.
Look, all of this can't be hunky-dory. Can you tell us where you can go wrong, or why should there be a case for anybody to invest in active fund management?
Whatever justification or research that you did or the testing that you did, most likely you would have done it on the past data. Now, when there is a regime change, what that means is whatever testing that you did on what you thought was effective may no longer be effective. A classic case is, for example, the crash during April-March 2020 during the COVID crisis, right? So at that point in time, you're basically entering an unknown territory. And then obviously there are this unquantifiable aspects, right? For example, things like promoter integrity, corporate governance, what has happened in the past with the promoter group. There are certain aspects, especially in India, right, where there's a limit to how much you can quantify some of these issues. No one can quantify promoter honesty.
Hello and welcome to Marcellus Musings, a podcast series which I host with various colleagues of mine. My name is Pramod Gubbi. I'm a co-founder of Marcellus. In today's episode, we have my colleague Krishnan, who heads our quantitative research function. And I hope to unravel a lot of myths and truths about quantitative investing. I do understand it's a new area for most Indian investors, but let me tell you, it's fairly significant part of the American market. In my previous avatar, on the sell side, I've serviced fund houses which are managing more than $1 trillion in purely quant funds. And for those who are unaware, who are big fans of Warren Buffett in the world of qualitative investing, in the world of quantitative investing, there is somebody who's got an even greater track record than Warren Buffett himself, a gentleman called Jim Simmons. Many of you may not be aware of him. He founded a firm called Renaissance Technologies, which was sort of the pioneer. No, I'm pretty sure there were other quant investors before him, but he had a legendary track record of, hold your breath, 66% compounding over 30 years. This is pre-fees, and these fees were quite hefty. Post-fees, it came down to 45%. It's still an incredible track record. There's a lovely book in the name of The Man Who Solved the Market. It's about this gentleman. I'm not sure what Krishnan does is very similar to Jim Simmons or very different, and that's why we're here to ask Krishnan what he does. Before he tells us about what he does, Krishnan, if you can just, rather than me introducing you, why don't you introduce yourself, your journey so far? How did you come around to sort of deciding that you'll build a career in quant investing?
Sure. And thank you for having me here, Pramod. So actually, I started out as an engineer. So, again, my background is, with, my first, I passed out of NIT Trichy with a degree in electronics engineering, and first 2 years just pre-MBA, right? And then I was exploring different career paths, and I didn't want to do an MS, and somehow I felt MBA was kind of more attractive because it offered you diverse career paths, right, depending on your interest, and it's that kind of an age, right, where the world is almost like an oyster for you, right? You can take whatever path you want, you choose. So again, that was the point. Again, I took this plunge, right? I ended up doing an MBA from IIM Kozhikode, kind of got drawn into finance. And so immediately out of IIM Kozhikode, I got placed into Goldman Sachs asset management. And I spent, the next 4 years just as a credit analyst, again, much more fundamental. So kind of analyzing companies, from a credit analyst or a credit investor perspective. So, you're looking at balance sheet, you're looking at cash flows, but more from, someone who was invested in the bonds of the company. So again, the team I was involved in was the emerging market corporate bond fund, right? This was again on the buy side. But again, the experience there was terrific, right? Because I got to work with pretty senior portfolio managers, right, who had spent 20, 25 years in the industry. So again, it was the first 4 years, I would say, very useful in terms of building my own fundamental skill set, right, on how to fundamentally analyze companies. And then from then, I moved on to D-Shaw again. It was a mix of fundamental and quant, but D-Shaw again, it was a quant shop. So even though I was part of a fundamental team, right, looking at financials, looking at again the analyzing these companies from a fundamental investor perspective, there was a lot of focus on, for example, analyzing data with programmatic, efficiency. That's why I started learning coding, right, and that's why I kind of got drawn into this whole field of quant finance, right, because everyone in D-Shaw nearly codes. So, that's where I started, doing a lot of these things myself hands-on. And I really liked, this whole field, right, which was kind of opening up in India at that point in time. But also when you look at it globally, right, when I realized the size of the market, especially in US, it was huge, right, for quant investors. For D-Shaw, obviously, one of the, few prominent ones. And then it's again, 2 years in D-Shaw, I got this opportunity to again move into a new product development team in Morningstar, where I was actually building rules-based equity and multi-asset indexes. Again, this was for global institutions, and that was for 3.5 years. And then this opportunity in Marcellus came. That was the point. I was this opportunity in Marcellus came to me again, and I felt again I was. Kind of suited for this role, uniquely placed for this role, given my quant and fundamental background. So yeah, that's been the journey.
Yeah, I mean, it sounds like deja vu to me. I'm also an NIT product. I think NIT Karnataka and NIT Trichy had a very fierce competition. Unfortunately, we used to lose to you guys in cricket. But yeah, I mean, most of us engineers in India end up in finance for pretty much the same reasons. So I'm glad you traversed that path as well. So coming back to the quant piece, like I said, quant has been a little, I would say, even an abused term when it comes to investing, because there's so many varieties of quant investing. Somebody who's doing a simple cash futures arbitrage would also reckon they're a quant investor.
Correct.
The other extreme, you have all these research affiliates. I don't know if many of the listeners are familiar with Rob Arnott, who runs one of the very highly rated quantamental firms, involves analysis of fundamentals. So Krishnan, what would be useful is if you can help us understand the entire landscape and then help us understand what you do fits in where.
Sure. So when you think about quant, right, in my case, the way I think about quant is any investing process which systematically, I think it's very important to emphasize that word, systematically uses data, right, and a lot of data to make decisions, investment decisions, right. Now, one easy way of distinguishing or differentiating among quant strategies is, look at the frequency of, how frequently you make these investment decisions. So at one end, you have what is called as high frequency traders, right, who kind of make investment decisions almost at a minute or, almost at a milliseconds or nanoseconds frequency. And again, that's completely driven by technicals, right? Price, volume, flows, right? And so on and so forth, right? So essentially they track minute by minute level data. So there again, you don't need a lot of understanding of business models or even finance, I would say, right? It's more about your how you've trained your model, right? And then how good is your technology, right? How good is your execution, for example? Because obviously, when you're trading at such a high frequency, remember that again, you want to minimize your trading cost, your market impact, whatnot, right? So that would be, one. I would say one end, what I would call as high frequency. And Jim Simmons, I would say, would kind of fall more into that, right? So it could be in fact, in my book, anything less than, 1 month you're making investment decision, anything frequently more than a month, I would categorize it as more into high frequency, right? And then you have mid frequency, right? Anything between a month or to, maybe say 6 months, right? That could be medium frequency. And then low frequency is, again, anyone who is doing, a combination of quantitative as well as, blending that with fundamentals, like, for example, taking the financial disclosures of the company, the balance sheet, P&L, cash flow, so on and so forth, and then using various characteristics, right, of these companies, along with, obviously, technicals, things like momentum, etc., to make investment decisions, right? But obviously there, it's kind of more closer in terms of making the frequency of making investment decisions is kind of closer to a more discretionary or a fundamental, strategy, right? What I think a lot of listeners would be kind of used to. But again, the way you're making the decision, again, like I said, right, it's systematic, right? So, and again, what we are doing here in Marcellus, again, what I do here in Marcellus would be the low frequency type, where we are taking information, obviously, again, basis, again, the financial disclosures of the company. We are taking the technicals, right? And then obviously we're looking at valuations, and then we're combining all this to make investment decisions, right? Now, if we get into, because again, I'm more knowledgeable on the low frequency side. So, just getting into what that means, right? So essentially you're looking at characteristics of the company, right? So when you're taking all these ratios, right, and making investment decisions, you're looking at, different things like, for example, profitability, right? We're looking at free cash flows, how consistent the company has been in generating its free cash flows, how operationally efficient the company has been, right? And obviously there are lots of ways you can, gather data. So again, I just kept myself to financial disclosures. Obviously there is alternative data out there, which we can discuss further, but essentially you're using, information, again, a diverse set of information, but essentially information on how the company works, right? How, the company allocates capital, and what do you think is the prospect of the company? Typically, such strategies also tend to be, far more, focused, I would say, maybe not concentrated or as concentrated as a discretionary manager, but far more focused, right? And typically the turnover also, like I said, because you're making investment decisions far more infrequently, right? Or, at least not more than, say, at least in my book, not more than a quarterly, I would say, the turnover would be, less than 100%, right? Now, obviously, if someone uses, something like momentum, which is also a characteristic, a stock level characteristic, then obviously your turnover could be a bit higher, but still, right? This is how I see the quant landscape, right? So one hand, high frequency, far higher turnover, and just looking at price, volume, and technicals, and then obviously the other end, right, which is closer to what what other discretionary managers might do, but doing it in a far more systematic, rules-based way.
Oh, so you are on the other end of the spectrum to Jim Simmons. So,
yes,
sort of no hope of a 66% track record for 30 years. In fact, I read somewhere that Jim Simmons, by the way, for those who didn't know, he was a mathematician. He was a maths professor at MIT, if I'm not wrong. And most of the people who worked for him at Rentech were also math PhDs. Almost none of them had any idea of company fundamentals.
So Pramod, Jim Simmons is known for, I think he had a famous quote that, he never recruit MBAs or something, right? So right. Apart from, that you said, right, again, me being on the other side of Jim Simmons, obviously, that also means I'll never be hired by Rentech even if I wanted to.
Yeah, absolutely. And your knowledge of fundamentals of companies would have been a detriment to that exactly. 66% track record. No, fair enough. You've given a reasonable understanding. So that's a useful, at least an introduction of the various aspects of quant investing. So you are saying you're taking what an active fundamentals-based investor would do, but you are entirely basing your investment decisions on data, not making any qualitative judgments about the future. Is that understanding right?
So I would say making qualitative judgments about the future. I mean, we might make qualitative judgments about the future, right? But again, that whatever decisions we make, that again is based completely on data, done systematically. In most cases, right? When I say done systematically, they would be validated, right? So typically, there would be, some kind of so that's, the whole point of, the research, right? So that's what, we keep on doing, day in and day out, right? Which is to look for signals and look for ways, right, in which you can improve, refine the strategy, or that's what I think many people do. And again, that could involve, for example, forecasting the future, right? And future you can look at in different ways, right? For example, you might want to reduce the risk, right? Or you might want to tilt to certain characteristics which you feel might do well in the future, right? Many investors also trying to time, for example, when they want to enter or exit certain trades, right? So again, it's a whole queue of, again, like I said, right, even within quantamental or, quant plus fundamental approaches, there's this whole spectrum of approaches. But anything that you're doing it systematically, and two, most likely you're also validating the system, right, or the set of rules that you're using to do whatever you're doing, whatever investment decisions you're taking.
Right. So yeah, I mean, the terminology could be a bit confusing. Some people use quantamental, some people use smart beta, some people use factor-based investing, but they're all referencing the same, I presume. And it helps to know the fact that the largest firm in this space, Dimensional Fund Advisors, had Nobel Prize winners Eugene Fama and French as part of the founders or advisory board of sorts. To that extent, there is some sort of credibility associated with the whole field. Now, could you explain to us, say, when you say factor-based investing, what are the factors that are we talking about? How are they different from each other? How do you go about assessing each of the factors, and why is it important?
Yeah. So when you think about factors, like I said, right, so you're basically looking at some characteristic of the company, right? And when I say characteristic, like I said, it could be profitability. It could be looking at, the free cash flow. You're looking at, things like, for example, what's been the revenue growth rate of the company, or the profit growth rate of the company in the past, right? So, again, and then you basis those factors, you're trying to, or those characteristics, you're basically sorting the stocks or, your entire universe basis, particular characteristic, right? And then you're looking at, whether that characteristic somehow would have given you some consistent return, right? Or have generated return for an investor who had just, invested, say, the top decile or the top quartile of stocks, just sorted on that characteristic, right? So that could be, that's, one definition of, what pharma French would define as a factor. So when you think about some of the mainstream factors, right, which have been shown to work across again, different countries, which have been shown to work across different market cycles, and which have also, again, shown to be fairly robust, right? In the sense that, like I said, they are both persistent as well as, again, they're universal. I would say there are, maybe 3 or 4 such factors, right? One is obviously value, right? So when I say value, again, you can have different definitions of value, right? You can look at price to book, right? So you can sort a company on, ratio, right? Just, the ratio of your market value of the company to the book value of the, or the book value of equity of the company. And then you could just look at, the returns for the top decile and then compare it with the, the companies which are at the bottom decile, right? Seemingly that spread, what you might call as a value spread, right? That has, been shown to be positive over a long period of time, right? In both in India as well as, in other countries. So that's what, kind of, that would be your definition of a value factor, right? Now, similarly, if you do something similar, for example, for profitability, you can use return on capital employed, you can use return on equity, you can use return on invested capital, no matter what the definition is, right? Essentially, you're looking at some way of defining, how profitable the company is or operationally efficient it is, what its margins are. So, you can use that then to, again, and then look at the spread, right? The similar way. And then you can say that whether, again, that's robust, etc. So that's another factor, right? Similarly, there are factors on low volatility. There are factors on, again, the most pervasive among them is momentum, right? Momentum, again, you're just looking at the last 12 month or the last 6 month return. And then, you say that, if I just, sort stocks based on the last 12-month or last 6-month return, and then I just look at the returns of stocks over the last which is in the top decile or the top quartile compared with the bottom quartile or the bottom decile, that again has a positive spread, right? So again, what that means is, if you think about a risky asset like equities and a riskless investment like FDs, right, a fixed deposit, why does equities give you more returns? Because you are taking more risk in equities, right? Because it's far more volatile as an asset class versus fixed deposit, right? Fixed deposit, again, you will not expect, any fluctuation in your invested value as such. So that's why you get a higher return, because it's a reward for someone to just sit through the fluctuation in the asset value, through their investment period, right? In a similar way, now if you within equities, right, if you start, dividing the return streams, right, between all these factors, right? This is why, they are called as smart beta factors, right? Essentially, it's not just plain vanilla beta, which is your exposure to equity. It's also exposure to all these underlying factors, which, gives you the overall return, right? So essentially all these factors, and this was, again, basis, Pharma French, right? And a lot of work done in Chicago booth in, late 90s, a lot of seminal papers which came out of there, which established that, again, these factors are not something that, they're not like, a flash in the pan, right? They have existed for a long period of time. And because US market history is longer than any other markets, right? You have close to 70, 80 years of reliable data. And you also have that, similarly 20, 30 years for, at least for developed markets, right? It has been shown that, these factors, again, they are reliable, and they are fairly robust, and they exist across all markets, right? And across different cycles. So that was, again, I would say the genesis, and, what you might call as factor investing, which is what we do here in Marcellus too. But remember that, again, all these factors, again, they exist for the risk premiums, or, the reward or the extra returns you get by investing in each factor. That is a reward for the risk that you take, right? So there is risk involved in when you invest in each of these factors. And by definition, when I say risk, they will be more volatile than your underlying equity returns, right? Simply because equity market returns is a combination of all these factors, if you think about it, right? And each of these factors, obviously, they do well in certain, environments. For example, value does really well when market, is coming out of a downturn, right? Typically, right? Because value stocks typically tend to be those stocks, again, industrials or, either banks, which will be the most affected during the downturn, or in case of industrial, they have most operating leverage, right? So when you're coming out of the crisis, right, you typically, the more levered you are, the greater is the benefit, right? So, as the economy improves, your revenues improve, and because your cost base is fixed, your earnings kind of go up, and that also means your price to earnings, etc., or your multiples also expand commensurately, which also means that the premium associated with value factor, is far higher, right, after a crisis than during any other point in the cycle, right? So that's one way of looking at factors. Again, that's one of the reasons, right? Also, when you go and speak to any of these quant funds or actively managed quant funds like ourselves, right? So we tend to not just focus on one factor, but combination of factors, because just focusing your investment on one factor, obviously it's not a good idea, because obviously the fluctuations would be far higher, and it's not obviously suited for any normal investor. It'll be very difficult for them to stay put. So that's why when you look at an actively managed quant fund, typically you're looking at multi-factor fund, which where they're combining all this different characteristic in different ways, right? And remember that, again, people say it's systematic. Obviously it's systematic, right? Because you have, like I said, there's a rules-based process. So you have, for example, some way where you are saying that, what is your definition of value and how you're sorting the stocks, so on and so forth. But there is judgment involved still, when you are even building even a simple multi-factor portfolio. Why? Because think about, for example, when you're building a value factor, right, what would be the metric you would use? Would you use just a price to book, or would you use something else, right? Would you use a price to earning, a price to free cash flow also, right? For example, we use price to free cash flow in how we define valuation or value. What is your look back period, right? So, for example, when you're, how long do you want to measure a particular metric, right? And there could be so many other decisions that you're taking, right? How you combine these two signals. Do you combine these signals at a stock level, or you're combining it at a portfolio level, right? So, example, a mixing versus an integrated approach, right? So so many decisions, right? Again, all those decisions, again, this is something that the fund manager or whoever designs, right, or whatever the research team works on, this is what they work on, right? Which combinations will work well, which combinations will give you the best outcome, right, in the long run, and which obviously is the most effective, and also which can meet the fund objectives, right, whatever it is, right? So point being that you could have a whole different, you could have two funds which are basically targeting the same factor, a value or quality or a value or momentum, but they could produce very different results simply because the way they are implemented, the way they are built. Yeah. Sorry, a long answer to your question, but I hope.
Okay, let me try and make it easier for the listener here. You rightly wrote your first newsletter building an analogy with Moneyball. Moneyball Correct. Was a great book written by Michael Lewis of Liar's Poker's fame. For those who have read Correct. His books, very enjoyable and enlightening at the same time. The book was later converted into a very popular movie, some of you might be aware, starring Brad Pitt. It effectively talked about how the manager of a baseball team in the US could construct a team within the constraints of the budget of that club, which is effectively what we as investors are meant to do. It's not just about buying all the great businesses. We want to buy great businesses at reasonable valuations. Now, I'm going to put you in a spot by saying, can you give us the analogy in the context of IPL? So if I have a fixed pot of money, obviously I can't buy 11 Virat Kohlis in the auction. How do you build such a team, and how do you connect that with your multi-factor investing model?
It's basically data that you're looking at. So it's, like I said, right, the emphasis on, the way you use data to make investment decisions. And you do, like I said, I mean, when you use, for example, just taking the IPL auction, maybe as an example, right? So if you're just, using data, right, and I say the player stats, right, and when you're looking at the player stats, remember, you're not looking at just the stats of Virat Kohli or the playing 11 today in the Indian cricket team, right? You're looking at stats for again, all the players who have played Ranji, right, on the domestic circuit, right, because that's your available pool, right? You don't care, because your data is again blind, right? Whether it's a Virat Kohli or it's a MS Dhoni or whoever it is, right? It doesn't look at stars, right? It's blind to star power or what we might intentionally look at, right, as human beings, because we kind of get used to or can get drawn to the news or the star power. Data is blind to it, right? So as long as you have that stats and you use those stats to make decisions, right? So one of the ways you can make a decision is, for example, just taking an example of Moneyball, right? So Moneyball, the whole story is premised on this, very, a very different coach. And obviously one of their problem was, again, the Oakland Athletics team, right? This was a baseball team. They were, not known, right? It was a fairly unknown team. It was a very small setup, right? Their budget was limited. Now, what do you do, right? When you have that, your budget is constrained. So you have a coach who thinks differently. And then he felt that, my budget is limited, right? I can't go and buy the most expensive player out there. How do I, pick my team or, build my team? So essentially what he said is, let me look at data, right? And there's a whole history of Moneyball, right? In baseball, for example, there's a lot of stats that's collected in US, right? For example, how many times, a striker hits the ball, how many times, they hit it out of the park, so on and so forth. So in India, for example, the similar thing, I'm assuming, nowadays data is widely available, right? They track, player level stats, for example, strike rate of the batsman, how, when they're striking, at what rate they strike, so on and so forth, right? So there's so many player stats you collect. Now, if you just look at, for example, and if you have someone who has looked at these stats, right, and they can figure out what is the most relevant, stat to focus on. It could be, for example, a strike rate of the batsman, right? It could be, for example, given the format, right? Maybe in T20, you want to look at, something like, how long this batsman actually lasts on the crease, right? Something like that, right? So you just look at, 3 or 4 stats, right? And then you look and you apply, the stats, or, this whatever you've come up with, the rule that you've come up with to selecting the team across all the players who are there in your Ranji or in your domestic circuit. Right. And it could be someone who has just spent, say, 1 year has 1 year, history, so far as I'm concerned, right, in a domestic circuit. And it could also be Virat Kohli, right? So the data treats everyone equally. They just look at the stats, right, and just select the best team, right, given the budget constraints, right? And also remember, if you use that kind of a setup to assemble a team, right, I would imagine that's very similar to what I wouldn't say, again, maybe it would be similar to a quant fund or a systematic fund using a value approach, right? So basically, you're buying the most undervalued players, right? Now you could also do a multi-factor approach, right? Where you could say, hey, I want some experience, but I also want someone who, even though they are expensive, we know that they can deliver. Right. So it's not only about value. Maybe you also want to emphasize quality, right? Maybe we also want to emphasize growth, right? So that would be a multi-factor approach. So you would have a Virat Kohli, you would have a Rohit Sharma, you would have a Ishan Kishan. You would also have, say, a very new player from, who's not played T20 at all, right? Or who has never played anything, right? And he has not done even a single international outing. So point being that, again, the key difference is you're kind of completely getting rid of the human, judgment aspect, right? Which some might argue is a negative, but in most cases, we know that at least, in whichever field, right, where there's a lot of noise and which, requires repeated decision making, right? It's almost always good to have it done systematically, right? Whether it's selecting your, team in IPL every year, or it's selecting the best set of stocks to include in your portfolio, say every 6 months or every year, right? It's the same thing. So again, but whatever be the case, right? So that's the analogy, right? So when you do something systematically, and again, you do it without the human judgment element, and also make sure that you're doing this across a lot of players, or, and that's where, you can maximize your impact of quant, right? Because like I said, as long as you have the data, remember, I can apply it on 10 players. I can apply the same process of selecting the team on 100 players. I can do it on 1,000 players. I can scale this up to 10,000 players, right? It doesn't matter to me. And data, like I said, is blind to all this, right? And you might get the next Virat Kohli, right, before they become the Virat Kohli. Remember, that's, I think the other analogy for stocks is you want to identify the next Asian Paints today, right? Not after it has, about it, exposed, but, before, Asian Paints becomes what it is, right? So again, you want to, buy the next multi-bagger today, right? In similar way, you want to buy the next, you want to have the next Virat Kohli in your team.
Now, with the point about human judgment you make, I think the data coming from the West is clear. We humans are horrible at decision making. There's plenty of data which suggests cognitive biases work against our best intention to deliver alpha. In fact, I think the latest number is something like 80% of active fund managers fail to beat the index. But smart beta or factor-based funds or quantamental funds seem to have a better track record. And from what you've achieved at Meritorque, the strategy you run at Marcellus, at a time when quality was under the pump, you managed to deliver a reasonably significant alpha over more than 2 years now, despite fishing in the quality pond. From what I understand, yours is also a sort of a multi-factor model where you fish in the quality pond. The universe is defined by quality, but the selection is based on valuation. You also have a secret sauce of a momentum running there. And I know that you also do some signal-based size tilting. So it is multi-factor. We'll do a double click in perhaps an episode later. What I want to capture is, look, all of this can't be hunky-dory. Can you tell us where you can go wrong, or where quantamental investing can go wrong? Why should there be a case for anybody to invest in active fund management?
Well, look, I mean, I think it's, to take the previous analogy of cricket, right? So, it depends on, what you are selecting the team for, right? So it could be, what is your style of selecting the team, right? It could be, that, you trust, you have someone who can, pick the best players, no matter what. They can, guard against emotions. If you have that kind of a person who is a selector in your team, then great, right? I would say I would make the same argument for active versus, a quant process. If you can find someone, right, a fund manager who can guard themselves against emotions, who are aware of, where they can, what kind of biases, they have, right, or they carry with themselves. It's very difficult, but there are good managers, right, who can deliver, alpha across the cycle, right? So I don't think, obviously that, this is going to replace, fundamental managers or active stock pickers. But where I think, coming back to what where Quant can go wrong is, typically the same areas where discretionary or, a human analyst or a human stock picker excels, right? Which is, first of all, when there is a regime change, right? When there is a sudden, change in the market conditions or, the economy, etc. So what happens is, because like I said, right, it's systematic. Now, systematic, you need to validate it, right? Whatever rules, you need to have a good justification. Now, whatever justification or, the research that you did or the testing that you did, most likely you would have done it on the past data. Right now, when there is a regime change, what that means is, that past data or the past hypothesis or, whatever testing that you did on what you thought was effective may no longer be effective. A classic case is, for example, the crash during March 2020 during the COVID crisis, right? So at that point in time, you're basically entering an unknown territory, right? No one has seen a global pandemic. No one knows what the impact would be or how long or, deep the correction will be, right? We don't know when the markets are going to reopen. You train your model on, say, a particular factor, right? Now, come, the March 2020, right? What do? Right? Do you go, do you follow the same process, or do you just go to cash, or do you still feel that, the factors that you have tested your model on, which probably has worked in normal conditions for the last 20 years, that might no longer work, right? So the question, and that's where, a human will be able to take a far better decision, right? Because they are looking they have their ears on the ground, right? So the, human fund manager might justify it by saying that, hey, I feel that I'm invested in XYZ company. I'm hearing from the management that it's no impact on, their, the business, etc. Or they're going to get, so much of support from the government. So that's why I have conviction and I'll stay put in these stocks, right? I'm not going to sell out, right? So, but a quant manager, obviously, because they're not looking at, a management commentary, or they're not looking at, these qualitative aspects, they might struggle, when such a regime change happens, right? Obviously, there are ways now where you can obviously overcome that, but I still feel that, right, this regime change is one area where human analysts and human fund managers will nearly almost have the edge. And then obviously there are this unquantifiable aspects, right? For example, things like promoter integrity. Things like, for example, corporate governance, right? Things, for example, what has happened in the past with the promoter group, right? Now, even if you stretch your imagination, right, even in terms of how deep you want to collect the data, right, for a particular company, what aspects you want to collect the data on, I still feel, right, there are certain aspects, especially in India, right, where, there's a limit to how much you can quantify some of these issues. Right. The real limitation is not there in terms of data. I think, some of these data points are soft. They are not quantifiable, right? No one can quantify promoter honesty, right? So that's where, the experience of the fund manager in that case, a cumulative experience of having, say, 10, 20 years in the market, right? Having looked at these companies, having looked at the promoters, having looked at their track records, maybe not in the same company, but in different avatars, right? And then being able to take a call on, whether this is a good long-term investment, basically being able to judge management quality. Right. I think this quant is generally, I feel, maybe not, I won't say, it can't go there. I think we can, using data, we can still get it to maybe 50%, the shortcoming, but I still feel, even if we have the best data, right, there are still aspects which I feel we will struggle to quantify, right? And then obviously, there are things like, for example, even when I say that, I don't have any emotions bias, like I said, right, there is still judgment involved in designing these models, right? And I keep on jokingly saying this, but I think I mentioned it to a lot of folks that, it's almost similar to making, any popular recipe, right? So, for example, if someone asks, I was just looking at this Master Chef show, right? So they usually give a recipe to the contestants, and they will ask them to make, a particular recipe. Someone asks us, the contestant asked to make gajar ka halwa, for example, right? Now, different people will make the recipe is the same, right? But different people will use, some combination of ingredients. They will make it in a different way, but this outcome will be very different, right? Why? Because essentially, they have used, obviously they've followed the recipe for most parts, but each one of them have added their own personal touch, right? And that's where, I think that's where, this, even though quant funds say that there's no emotion involved, there's no bias involved, still there is judgment involved, right? Now, I don't know to what extent it could be a distraction, but it's not one size fits all, in the sense that, like I said, right, two quant funds doing exactly the same thing, right, targeting the same factors could have completely different outcomes, right? So that's also something to be aware of, right?
For those human beings who can be aware of their emotions, keep their emotions under check, they do stand a chance of doing better than a model. But I must, quote Daniel Kahneman, who's perhaps done the most work. He indeed won the Nobel Prize on a subject related to human biases, cognitive biases. When he was asked that, look, you've done a whole host of research on the fact that humans are subject to their biases, which sort of causes problems in terms of decision making. Having done the research, how do you get over those biases? His simple point was impossible. Humans are evolutionally flawed to be not be unbiased, and therefore he invests all his money in index funds, not relying on a human being making those judgments. Anyways, I think there's a lot to double click here. We'll come back to you. I want to touch upon aspects on the influence of index investing or passive investing in quant investing. We also want to touch upon your most recent fascinating newsletter about rebalancing of assets in a portfolio which are uncorrelated. The results were just stunning. There's plenty to dig deeper, but that's for another day. But thank you so much, Krishnan. It's a pleasure having you on this podcast. I totally enjoyed the discussion and look forward to the next one.
Thank you, Pramod. Thank you for having me here.